Hello and welcome to Navigate AIF everyone. My seniors used to always tell me that whenever a new SEBI circular comes, make sure that you read the entire circular line by line and not just read the articles on that circular. So in this video series what we are going to do is go over the entire SEBI circulars that have been released in recent times. We begin with the circular released on 19th August 2024, that is the guidelines for borrowing by Cat 1 and Cat 2 AIFs and the maximum permissible limit for extension of tenure by LVFs, that is large value funds. SEBI AIF regulations have been amended and notified on 6th August 2024 with respect to firstly the norms for borrowing by Cat 1 and Cat 2 AIFs, and secondly the maximum permissible limit for extension of tenure by LVFs for accredited investors. And the copy of the aforesaid notification is available here. So you all must be knowing that the regulations have been amended, and this amendment was also mentioned in the SEBI board meeting in June. Now, what do these guidelines say? Firstly, in terms of Regulation 16(1)(c) and Regulation 17(c) of the AIF regulations, Cat 1 and Cat 2 AIFs shall not borrow funds directly or indirectly or engage in any leverage for the purpose of making investments or otherwise, except for borrowing funds to meet temporary funding requirements and day-to-day operational requirements for not more than 30 days on not more than 4 occasions in a year and not more than 10% of the investable funds, and subject to such conditions as may be specified by SEBI from time to time. So in furtherance of this regulation, SEBI has now specified the conditions by virtue of this circular. So let us look at Regulation 16(1)(c) and Regulation 17(c) first to get a better idea of what the regulations say with respect to borrowing. So we can see Regulation 16(1)(c). Yes, so 16(1)(c) is conditions for Cat 1 AIFs, and if you see clause C, it says Cat 1 AIFs shall not borrow funds directly or indirectly or engage in leverage for the purpose of making investments or otherwise, except for borrowing of funds to meet temporary funding requirements and day-to-day operational requirements for not more than 30 days or not more than 4 occasions a year and not more than 10% of the investable funds, and subject to such conditions as may be specified by the board from time to time. Next, provided that Cat 1 AIFs may create an encumbrance on equity of investee company which is in the business of development, operation or management of projects in any of the infrastructure subsectors listed in the harmonized master list of infrastructure issued by the central government, only for the purpose of borrowing by such investee company and subject to such conditions as may be specified by SEBI. Next is Regulation 17(c). So looking at Regulation 17(c) once, 17(c) says the same for Cat 2 AIFs. Actually, it's essentially the same thing for Cat 2 AIFs, and we have already discussed the borrowing requirements here. So let's go into the details of the circular. First, it's specified that in this regard, in order to facilitate ease of doing business and provide operational flexibility, so this is the reason why the circular was introduced, it has been decided to allow Cat 1 and Cat 2 AIFs to borrow for the purpose of meeting temporary shortfall in amount called from investors for the purpose for making investments in investee companies. So you can now borrow to meet the temporary shortfall in drawdown amount that is called from investors for making investments in investee companies. If you read the fund documents, typically there are provisions for default in case an investor does not meet the drawdown notice requirements, that is, the investor does not pay the amount that's called in the drawdown notice, then the manager generally has a flexibility to term that investor as a defaulting investor and levy certain penalties on them. So they can charge, say, a default interest. Importantly, that investor must not be allowed to make any further investments until they have paid the required amount under the drawdown notice. So that is generally mentioned in all the PPMs. So now you can borrow to meet the temporary shortfall caused by such investors. So Cat 1 and Cat 2 AIFs may borrow for the purpose of meeting shortfall in drawdown amount subject to these conditions. So let's see these conditions. First, if the AIF intends to borrow funds for meeting shortfall in drawdown amount, the same shall be disclosed in the PPM of the scheme. So first, if you are intending to borrow for this purpose, make sure that you revise your PPM to provide for this borrowing, that is borrowing to meet shortfall in drawdown amount. Such borrowing shall be done only in case of emergency and as a last recourse when the investment opportunity is imminent to be closed and the drawdown amount from investors has not been received by the AIF before the date of investment, in spite of best efforts by the manager to obtain the drawdown amount from the delaying investors. So, a lot of key things here. Firstly, this is talking about when can you say that, okay, now as the manager, I'm not able to meet the required amount for the investment, hence I need to borrow funds. So, what is the threshold and what are the criteria when you can actually start borrowing? First, you have to borrow only in case of emergency and as a last recourse. So this is important. Then you have to show that the investment opportunity is imminent to be closed. So you are close to finalizing the investment and you have to now pay that money to the investee company or whoever the securities are being purchased from. And the drawdown amount from the investors has not been received before the date of investment, in spite of best efforts by the manager to obtain the drawdown amount. So this could be sending reminders, reaching out to the investor, asking them to make the payment for the drawdown amount. All these things have to be done before the AIF can actually borrow money to meet the shortfall in drawdown amount. Also, importantly, SEBI has not called them defaulting investors, but only delaying investors, because the manager may choose whether or not to classify them as defaulters. So this is something we notice here. Then the next thing is the amount borrowed shall not exceed 20% of the investment proposed to be made in the investee company, or 10% of the investable funds of the scheme of the AIF, or the commitment pending to be drawn down from investors other than investors who has failed to provide the drawdown amount, whichever is lower. So there are three thresholds that have been specified. First, 20% of the investment proposed in the investee company, that is one threshold. Next is 10% of the investable funds. And the last one in pink here is the commitment pending to be drawn down from investors other than those who have failed to provide the drawdown amount. So those investors who have already made the payment from their undrawn capital commitment, you can that can be a threshold as well. So whichever is lower out of these three is the threshold that is mentioned for borrowing of funds by the AIF. The cost of such borrowing shall be charged only to investors who fail to provide the drawdown amount for making investment. So only the dealing investors can be asked to pay the cost of such borrowing. What will be the cost of such borrowing? This could be the interest amount that the AIF may have to pay for borrowing these funds. Next, the flexibility of borrowing to meet shortfall in drawdown amount shall not be used as a means to provide different drawdown timelines to investors. So this is interesting, because if you see the SEBI template PPM and you look at the side letters clause in section 7, you will notice that the side letter clause says that you cannot give better terms for investment, you cannot give better terms for drawdown. So SEBI does not want that this circular or this arrangement be used to give different drawdown timelines to different investors. You have to make sure as a manager that you provide the same drawdown timelines to all investors. So SEBI has tried to ensure that misuse doesn't happen here. The manager shall disclose the details with respect to amount borrowed, terms of borrowing, and repayment to all investors of the AIF or scheme on a periodic basis as per the terms of the agreement with the investors of the AIF. So the agreement with the investors of the AIF could be a contribution agreement or a subscription agreement. Here you can see there's another requirement to amend the fund document. So we saw two requirements to amend fund documents. First was here in the PPM. You have to mention in the PPM if the AIF intends to borrow funds for meeting shortfall in drawdown amount. And next you have to amend the contribution agreement to disclose the details with respect to amount borrowed, terms of borrowing, and repayment to all investors of the AIF or scheme. Further, all category 1 and category 2 AIFs shall maintain 30 days cooling off period between two periods of borrowing as permissible under the AIF regulations. The cooling off period of 30 days shall be calculated from the date of repayment of the previous borrowing. So between two borrowings that the AIF does, there has to be a 30-day period, and even the calculation has been specified here. Next, we talk about the maximum permissible limit for extension of tenure by LVFs. So in terms of proviso to regulation 13.5 of the AIF regulations, an LVF may extend its tenure up to 5 years subject to the approval of 2/3 of the unit holders by value of their investment in the LVF, and the extension in tenure of any existing LVF scheme shall be subject to such conditions as may be specified by SEBI from time to time. So as you may be aware, SEBI has mandated that no AIF can go beyond its tenure. SEBI wants all AIFs to end the scheme, liquidate all your investments, or you go into dissolution period, but all of this has to be done within the tenure specified because SEBI considers this very important. There have also been important litigations in this matter, such as the Urban Infra matter, the Vistar Religare matter. So we have judicial precedent as well as statutory mandates here requiring AIFs to ensure that they exit, liquidate their investments, or go into liquidation dissolution period or liquidation scheme, distribute in specie, but they have to make sure that they end the AIF within the tenure of the AIF. Now for LVFs, this was a little different because LVFs are allowed to extend their term for an unlimited number of time under the existing regulations. Extension for normal AIFs are for 2 years, so 1 plus 1, and for LVFs this may be up to 5 years. We can even look at the regulations once for better clarity. So if you see regulation 13.5, extension of tenure of the close-ended AIF may be permitted for up to 2 years, subject to the approval of 2/3 of unit holders by value of their investment in the AIF, provided that a large value fund for accredited investors may be permitted to extend its tenure up to 5 years, subject to approval of 2/3 of unit holders by value of their investment in the LVF. So now LVFs cannot have unlimited term, they can also extend only up to 5 years. Now what has SEBI specified in this regard? First, existing LVF schemes who have not disclosed definite period of extension in their tenure in the PPM, or whose period of extension in the tenure is beyond the permissible 5 years, shall align the extension in tenure with the requirement given in paragraph 6 above. So the requirement of extension being up to 5 years, they have to align this within 3 months on the date of the circular, that is on or before November 18, 2024. So if you are an existing LVF scheme and you have not disclosed definite period of extension in the PPM, definite period of extension of tenure in the PPM, or your period of extension is beyond 5 years, then make sure you amend your PPM before November 18, 2024. This is important and this is the deadline set by SEBI. And in an interesting way, to ensure that LVFs actually comply with this, what SEBI has said is such LVF schemes shall update the revised period of extension in tenure in the quarterly report submitted on the SEBI SI portal for the quarter ending December 31, 2024. So in your December 31 quarterly activity report, you have to update your period of extension. So SEBI will ensure that everybody has complied with this requirement in this way. While realigning the period of extension in tenure, the LVF schemes shall have the flexibility to revise their original tenure subject to the consent of all the investors of the scheme. So now with this provision, LVFs can actually revise their original tenure, so they can reduce it or extend it. If say the original tenure was 10 years, now they can make it 12 years, 15, 20 or 8 years, and they have to make sure that they allow extensions for only 5 years. But importantly, this requires consent of all investors of the scheme. Such LVF schemes who are choosing to revise their original tenure itself must submit an undertaking to SEBI on or before November 18, 2024, stating that consent of all investors of the scheme has been obtained for revising the original tenure. Accordingly, conditions for extension of tenure of LVFs as given in paragraph 12.14 of the SEBI Master Circular dated May 7, 2024 for AIFs shall not be applicable with effect from the date of the circular. So if you look at the SEBI Master Circular for AIFs, under clause 12.14, it says that regulation 13.5 of the AIF regulation permits close-ended AIFs to extend the tenure up to 2 years with the approval of 2/3 of unit holders by value of their investment in the said AIF, while the proviso permits LVFs to extend its tenure beyond 2 years, subject to the terms and conditions of the contribution agreement, other fund documents, and such conditions as may be specified by the board from time to time. In this regard, it has been specified that to enable the investors to take an informed decision, the PPM, contribution agreement, or other fund documents shall lay down the term for extension of tenure beyond 2 years. LVF shall be required to obtain approval from its trustee, board of directors, designated partners for extending the tenure beyond 2 years, at least 1 month before the expiration of the fund tenure or extended tenure. And in case requisite conditions specified in the PPM, contribution agreement, or other fund documents for extension of tenure beyond 2 years are not fulfilled, then the LVF shall liquidate and wind up in accordance with the AIF regulations and circulars. So now this is no longer applicable and the extension has been limited to 5 years only. Last and most importantly, the trustee or sponsor of the AIF, as the case may be, shall ensure that the compliance test report prepared by the manager in terms of Chapter 15 of the Master Circular for AIFs includes compliance with the provisions of this circular. So, the trustee or the sponsor of the AIF, in case it's a trust or an LLP, they have to make sure that the compliance of this circular has been ensured in the CTR that is done annually. So I hope you understood all the key provisions of this circular and it gave you a clear idea of what SEBI has specified with respect to borrowing for category 1 and category 2 AIFs and extension of tenure of LVFs. And if you have any questions, then do let me know.